All right, everyone. I've got a question today from Roundtable member Vinoobhai, and he's asking about what I mean when I'm talking about the leave or take 8 and leave 2. Boy, that looks like hieroglyphs. I don't know what's going on with my pen. Bear with me here. So leave 8. Gotta draw really slow, evidently. So take 8 and leave 2. So this would be take, and this would be leave. All right, a little bit of background. Most retail traders are really looking for something that will predict the market, right? We look at this chart here. This is the euro. And we see all of these beautiful reversals. And I remember doing this when I was a young trader. I would go in and calculate the low to the high, and I would think about, man, what would happen if I bought here and sold right there and bought back again and sold again and bought back again and sold and bought and sold and bought and sold. And that's just a total like fantasy. I mean, it's pipe dream. It's simply not going to happen. What I learned once I got into the professional world was why it's not going to happen. You see, these reversals are created by people. Now, I know a lot of retail traders think that computerized trading is like this huge part of the markets. And it's just not that way. The vast majority of the money in the market is still controlled by a human, meaning it's not computerized trading. Yes, there is quite a lot of computerized trading. Nobody really knows the actual number, but I do know that there are thousands of firms which control, and I'm totally guessing here, a couple of $1 billion. Well, to put that in perspective, one of my trading mentors controls $6 billion. So, when you put together the largest single professional traders, they're bigger than most, if not all, of the algorithmic trading that's going on. That's number one. Number two, most algorithmic trading is done in a very specific way. So they're looking for example, a specific news story or specific words to go out in news stories. They look for specific prices. So the algorithmic traders will look for a breakout, and they're going to try and take 20 or 30 pip profit on literally thousands and thousands of very small trades. So it's a complicated thing that has nothing to do with how most retail traders trade. Now, why am I talking about all that to answer Vinoobhai's question? Well, because you've really got to dig into what you think is possible in the marketplace. And so if you think it's possible to predict the low and predict the high and somehow come up with a trading system where you're somehow predicting the future, I'm the wrong guy to listen to, because that is not going to happen. Totally impossible because of the way the low is created. So let's talk very quickly about how a low is created. First of all, sellers have to come into the market, and they are pushing price down. As price reaches a certain level, and by level, actually I'm talking more about a certain zone of prices, professional traders look at the marketplace and they decide to buy. Now you have to remember, in order for anyone in the world, I don't care how much money you have, in order for you to buy, someone must be willing to sell to you. Look, this stuff isn't created with, fairy dust and peanut butter. This is an actual contract to deliver a specific amount of currency, and that contract is created the second you push buy or the second you push sell, whether you're trading in the retail market or you're trading in the interbank market, the professional market. So the professional traders need someone to sell to them if they are going to buy. So the professional money sees that price has reached an area that they want to buy. They see that there are sellers in the market, so they step in and buy. Now, who are they buying from? Well, you have to understand, again, how the market works. The market actually has a three-party system, if you will. And so I'll put the market maker up here, and then I'll put a couple of my Picasso-style stick figures here and here. Okay. The market maker is really, I think, the key to understanding everything that's behind this whole 8 and 2 idea. Okay. So the market maker steps in if there are not two people to trade, or the market maker oftentimes is simply the logical choice. Here's what I mean. If price is going to go down like it does right here and people are selling, more than likely they're selling to this market maker here. Well, now this market maker has bought these contracts. That literally means the market maker now has an obligation to buy a specific amount of currency. In the interbank market, that contract can and usually does expire in 3 days. So that there's like a real obligation here to deliver a physical product, or in our case of currency, an electronic product. So the market maker needs someone to lay that off on. In other words, they need to find someone else who's willing to buy. Okay, so this guy sells, the market maker now owns it, the market maker needs to find somebody to buy. So the market maker, if they start seeing a bunch of people selling, and they're taking in all of this inventory, they're going to look at the marketplace, they're going to pick up the phone and call, and they're going to find out, where are these buyers? And they're going to call the professional traders. Look, they're not going to call you. You've got, a minuscule amount of money in your account. And by that, I mean, you don't have $5 billion, right? You don't have hundreds of millions of dollars in buying capacity. So you're never going to get one of these calls, and neither am I, because I'm not trading with that kind of cash. So the market makers are calling around. They're finding out who's going to take this inventory. They move price down there as best as they can until it reaches the zone. Remember, we talked about the zone. And then, all of a sudden, these institutional buyers will step in. So the market makers start selling to them. That's the way a low is created. It's not peanut butter and pixie dust. This is the way that it's done. Now, you can substitute. This could be an electronic trader. This could be an algorithm. I mean, it really could. But in today's market, for the time being, it is a live human being that's doing this. Now, when all of these contracts are soaked up and there are no longer a lot of sellers, then what happens? Well, these institutional traders realize, oh crap, I need to have price go up. So they start pushing price back up. Why? Well, because they own currency. Okay, so with all of that in the background, the question is still, what's up with this 8 and 2 business? If we can't predict the market, we have to ask the question, well, when do we take profits? So this is take, this is leave. The problem we have is we look back and see these lows and these highs, and they have all the appearances of something that's easy to find, easy to predict, and it's like, well, man, we ought to be able to do this. Well, you can't. So because you can't, because you and I don't create price, meaning we're not the professionals that are getting the call, we need to come up with some way to take profits. In other words, we need some money management style that will protect our profits while reducing our risk. So if we have looked at the marketplace, and let's use this, well, we could use this high if we wanted to, but if we use this low, so say we bought in this low and price starts to go up. If we're day trading, we want to take profits as quickly as possible. So, remember, the insider code is talking about day trading techniques. It's not swing trading. It's not 3 or 4 or 5 days at a time for the most part. It's day trading. So as soon as we have a profit, we take 8 contracts off the table. We leave 2 contracts on, meaning we're taking profit. So if we've bought, we then sell 8. Now you can think of this as 80-20. If you're not trading a 10 lot, you can think of it simply as 80%. So you want to take off the big chunk, 80%, and leave on the small chunk, 20%. Whoops. 20%. It's a way to protect profits, but to leave some of the position on so that if the market does continue to move, you can continue to profit, because we are trading in an environment where we have no control over price, because we are not the ones working at the firm, or we are not the individuals responsible for turning price. So that's what I mean by take 8, leave 2, or 80-20.